his company, as well as, well, the Egyptian Hotel Association. Adham, would you like to briefly address your members before we get started?
Yes, sure. Thank you, Carl. I would like just to give a quick welcome to everyone. I'm very happy to have you all, and always looking forward for this amazing collaboration with Sommet. I would like to thank Mr. Albian as well for joining us today. Thank you very much for taking the time.
Thank you.
And hopefully this could be a eye-opener session for some of the members, and we can also share it later on with the people that did not attend. So welcome everybody, and let's go for this amazing session.
Excellent. So let's go for this amazing session. Albian, that's a cue for you to take over and to present investment appraisals in the hotel industry.
Wonderful. Thank you, Carl. Really appreciate it. Thank you, everyone. We have a small group today, but I think that's quite perfect. My name is Albian Albrahimi from Albania, AAA, right? So I'm the assistant dean of the graduate school here at Les Roches, Montana. So I oversee the overall academic experiences of all the students that go in their journey with Les Roches, be that from postgraduate like MSCs, MBAs, but also executive MBAs as well. Carl, can you give me control to the presentation so I can change the slides, or do you think that would work?
Great idea. I think I just did.
Hold on. Otherwise, I can share from my own screen. Hold on. Yes. Is it working? Okay, perfect. Wonderful. Thank you. Okay. So I have a background in finance myself. So I've got a bachelor's in finance, a master's in finance, and a PhD in financial accounting. So it's within my world to always think about numbers whenever I am looking into some analysis of the hotel industry. It always comes naturally to me to think about, okay, what's the cost? What's the overall value that is created from a particular investment, right? So what we'll be talking today is the investment appraisals in the hotel industry. And Carl asked me to mention a few interesting components also on how this applies to Egypt in terms of the hotel development as a potential for the future, right? So we are now into a great investment cycle in Egypt with more than 45,000 rooms that are in the pipeline. You have international brands that are really pouring in, and then you have mega projects like Ras Al Hekna with more than $35 billion under investment. We also have the Grand Egyptian Museum that is getting a lot of attention lately. So the question is not necessarily whether it's time to invest, but how do investors make the right call, right? What kind of analysis they do, what information they take into account. So before we look into the overall hotel industry, we need to kind of zoom out a little bit to the whole real estate commercial landscape, right? So we normally categorize commercial real estate into 5 main categories with offices such as towers, headquarters, type A, type B, type C offices. That's our number 1 category. Then we have the retail category where we include malls and outlets and other types of retail businesses where we only collect rent. We have industrial, multifamily, and special purpose. The hotel industry normally fits within the special purpose type of hotel. So why is that important? That's because hotels are normally operating businesses within a real estate shell. So an office building generate leases from a lease contract. That would be option between 1 and 4. So you're making only generally passive income. However, from a hotel perspective, you generate revenue from 2 main sources. Number 1 is you're running an operation, you're running a business, so that means you have an opportunity to make money from running that overall business. And number two is your capital appreciation or the asset appreciation over time. That makes you a lot of money. So it's very important to understand that from an investment perspective, that we are sitting into a special purpose type of a real estate where the value of the particular asset is not on the square size, is not on the only on the location, but also the value of all the services that it provides, that it encapsulates. So what makes hotels unique? That's then the next question, right? So these are some elements that we always need to keep in mind, that we can maximize the overall value of a particular investment, right? So hotels are unique because they provide services, and these services are a little bit special compared to other manufacturing, merchandising types of industries. So number one, a characteristic of services that we provide in hotel is the intangibility component between the moment when the service is sold and when it is experienced, right? So you cannot see it, first of all, the intangible component, you cannot see the service. It's an experience. How do we evaluate that experience? That's when it gets difficult, because you're not in a position to ask always the guests right away to evaluate that overall experience, because the higher the value of the overall experience, the better off will you then be from a value perspective. The second characteristic of services that we offer in the hotel industry is the inseparability, meaning that once you sell a service, you produce it and you consume it at the same time. You cannot stack inventories of rooms with the purpose of reselling them later, right? So that becomes a very important component when it comes to managing the overall number of rooms that we have when we are in high seasons versus when we are in low seasons. So the inseparability component is quite important in periods when we're full. We are running at 90% occupancy. Now we need to figure out, okay, how much additional value we can get from that, right? Using pricing management and distributions as well. The third component, which is quite interesting, right, for services in general, that's perishability, meaning that any hotels, any rooms that are remained unsold, we cannot go back in time and sell them. So we lost that particular revenue forever. That's again what gave the rise to the whole revenue management as a department. That's why we creating our different segmentations for the customers that are coming to our hotel. And the last but not least important characteristic is the variability. So the quality of the service that we offer varies from time to time. Even though with the chain hotels, with the different standards that we set, we try to ensure a certain level of standardization. Is not always possible. And that's not a bad thing. Okay, so I always want you to keep that in mind. We do want a certain level of standardization, as in minimum level of experience that we want to offer, but variability will always remain there. That's why in the hotel industry, we're not always afraid that the robots and AI will take our jobs, right? It will always need that human experience. But from an investment perspective, what makes hotels unique? And there are some of the very few types of investments that are both capital intensive and labor intensive. What that means is hotels, they require a big amount of investments in terms of fixed assets in order to be able to have that property from an investment perspective, right? So you need to put a lot of money. And at the same time, in order to run the overall operation, you also is one of those industries that has the biggest amount of labor. So you have a huge amount of fixed costs that are involved. So you need to rely on a lot of capital, and you need to rely to a lot of fixed costs versus variable costs. So that creates an interesting dynamic that you generally, in most industries, they're either capital intensive and then you rely into a lot of automation, so therefore labor is quite a low amount, right? Or you will rely into a lot of labor, and that in that case you don't need a lot of capital. If you're an accounting firm, for example, you mainly need labor, but not capital, right? If you are into manufacturing, you need capital, but usually labor is a lower amount. So this creates a very, very interesting dynamic. And when you combine that with seasonality, especially the labor part, we operate in an overall environment with huge seasonality. That means we really need to model our operations from low seasons to high season, and even small adjustments to the overall operation structures, they will make huge implications onto the value of a particular investment. So that's something we need to keep in mind. Nevertheless, there is some good news. There is some good things, right? One of that being the low working capital. So typically hotels do not need a big amount of working capital. For those of you that do not know what we mean with working capital in finance, we define it as the amount of resources that we need, short-term resources, to run our day-to-day business, right? And because we have the component of inseparability, we don't have a lot of inventory. And we cannot keep a lot of inventory, right? So that means there is only labor, the component that we need to have on a daily basis, but there is no inventory, there's nothing that we need to store and so on. So that makes our day-to-day operational activities needing less cash in order to make it happen. Nevertheless, the operational intensity is also a very interesting component of hotels that provides sometimes a risk in terms of low seasons that you need to keep the hotel running, but at the same time, you are running an asset that never sleeps. That means you have a lot of opportunities to come up with new products, come up with new creative ideas to generate revenue and to enhance the overall experience of the guests. So what are the three main parties that are involved in a hotel investment? Well, there's normally three of them. So there's the owner, there's the operator, and there is the lender, right? So what I want you to remember from this point is that the owner is usually the one that has most of the control in this hotel investment, because again, they provide the capital, they take the majority of the risk, they bring the vision, the team, and everything, right? So they drive the overall investment decision. And one thing that we always need to keep in mind is, what do the owner wants in an investment decision, right? Normally they will want three things: income, asset appreciation, and control. In the moment where we are working for the owner, depending if we are the operator or if we are an asset manager, right, that's our main goal, right? How can we increase the overall net income for the owner in a way that it is sustainable? That's a very important component, right? You can always increase short-term profit, but we need to remain a sustainable income generation. And obviously what maximizes the overall wealth for the owners, okay? The second component, or the second party, is the operator, that normally the owner will hire to run the hotel. Sometimes you can even have owner-operator types of investments where the owner will decide to also operate it themselves. You also have franchise models and so on. So depending on the model of who's running the hotel, we need to always keep in mind what are the overall implications. But there is costs that are involved here, because obviously we'll have to pay a base fee and an incentive fee to our overall operator. And then finally we have the lender, who's the third party, but one of the most important ones, because they provide the majority of the capital, right? They will usually get a fixed return. We are operating in a very interesting environment in the hotel industry, because lenders out of the 5 categories of real estate that we saw, right? So offices, malls, manufacturing, factories, and so on. Hotels are a very attractive piece of collateral for lenders. So that means we are operating in an environment where it's easier versus other types of real estate for us to normally to attract lenders to provide us with capital. So these are some important points that we need to always keep in mind. So owner is what we have to keep in mind from an investment perspective, right? We are evaluating this overall business from an ownership perspective. However, not all owners are the same. We have different types of owners. In normally categorizing them into three main categories. Sorry, my bad. I'll go back to that idea, to that slide. So every owner has a different risk appetite in mind. Number one, we consider to have owners that are part of the overall core investors, right? So we have these type of investors. They usually require lower risk. That includes pension funds, insurance companies, family offices. What they want is stable income. They want minimal leverage, and they want a low level of drama in the sense they don't want a lot of things to go wrong. We have private equity that are normally looking for value-added types of investments, right? So there's real estate funds. What they look is they're looking usually for repositioning types of opportunities in the sense of they want to find assets that are not performing so well, and then they want to enhance their overall operations in order to increase the overall value. And then finally, there is the third category of owners that are usually opportunistic, and that includes developers and private funds that are aiming for new constructions. They're looking for emerging markets, and usually because they take more risk, they're getting a higher overall return. So as an advisor or as an investor, you always need to keep in mind what type of strategy you are executing, right? So because the overall evaluation approach will be different whether you are evaluating an investment for a core fund or whether you're looking into a flip for 5 years and then going back into another type of investment, right? So going back to my slide, why do we invest in hotels? There's usually 6 main reasons that normally we like to understand when it comes to the owner, something that we always try to keep in mind, right? We invest in the hotels for the cash from operations from an annual perspective, right? So steady stream of cash flows, number one. That would be the core type of investors, the pension funds and so on. They want fixed cash flows. We are also looking for asset appreciation. The same thing is for a property. If you buy an apartment that you want to rent, you want to get your your monthly rent, but also increases in value. For businesses, a lot of maintenance costs, a lot of the costs that you operate in the hotel, you can get a tax shield, you can get some tax deductions and benefits from these investments. So that's something that we need to keep in mind. We use it as an inflation hedge. Keep in mind, in Egypt, you have so much volatility in the currencies that we need to always reflect that into our pricing. And if it is an asset investment, it normally serves as a hedge, as it will go further up on time. We also have additional development fees in some situations that we can generate additional revenue from auxiliary revenue from offering different types of services like parking and spa and so on. And then finally, some investors, they also want that prestige as an opportunity to make that investment. So if we're looking for an investor that is focusing on value added in terms of a strategy and wants to have that prestige, then we may have to consider additional components from a feasibility perspective, right? Not only the financial element that is relevant, but also additional heritage value that could have for that particular owner. So the numbers speaks for themselves, particularly in Egypt. So we have for 2025, we had about 19 million tourist arrivals. The overall government target for 2030 is 30 million, so that's more than 33% growth over the next 4 years. We're looking into a huge amount of tourism revenue, about $18 billion for the overall country, with more than 45,000 of rooms in the pipeline. So some interesting developments. Again, the Grand Egyptian Museum that just opened recently. There is obviously attracting a lot of tourists, a lot of travelers, so that will have implications for many of the hotels, and that's something that we need to incorporate in our forecast. Ras Al Khaimah with 35 billion development that is creating a lot of interesting developments there. Pipeline, as we said, in Egypt, we are looking into one of the main leaders of the African region. That's more than 30, almost 30% of the overall pipeline for the whole Africa. And then you have the launch of the Bank Misr EGP 3 billion fund, which basically now has a mandate to invest into a lot of hospitality properties, right? And then you have an international brand. You have Hilton that wants to triple their overall portfolio. You have Marriott, Accor, and all of these are expanding. Nevertheless, because of the currency volatility, you have increases in construction costs. All of these additional elements, they need to be reflected in the feasibility analysis overall. Yeah. So how do we perform a feasibility analysis or a feasibility study? Usually, before we even think about what is the net present value, what's the internal rate of return, we need to answer the fundamental question that generally focus on should this hotel exist in a particular location, in a particular market. Again, may not necessarily have to do only with the financial component, but you need to think about the overall market analysis. So what's the overall supply dynamic in this region? What's the overall demand? How is the competitive set in the area? What are the seasonality patterns and so on, right? So that's the first question that we need to ask ourselves. Then on the second step of the feasibility study, we need to think about location. We need to think about accessibility. Is there an airport nearby? Is there any protected areas? What's the infrastructure looking like, right? Moving into then the third step, you need to think about what kind of hotels we are going to build. How many rooms? What type of facilities do we need to include? Should we invite a Hilton? Should we invite a Marriott? Should we invite a soft brand where we want to enhance more the overall local experiences, right? So these are all questions that we need to answer. Obviously, the concept development needs to have a connection with the overall cost estimate, right? So we need to think of what's the overall cost in terms of construction, furniture, fixtures, any pre-opening costs, how much working capital do we need? Is there any contingency that we need to keep in mind if some things go wrong, right? So these are the first 4 steps before we even think about going into deeper forecasts in terms of what will the hotel generate, right? That would be our step number 5. Normally, we perform a 10-year P&L, starting usually with market growth, our positioning within that particular comp set, and then that will help us determine the revenue forecasts, any ramp up that we will need in terms of operations. Do we need more staff at a certain point, right? What's the RevPAR trajectory in the next 10 years? And then finally, when do we reach a stabilized net operating income. So the last bit, that's where most of the mistakes normally happen. Okay, so that's why I put that in black. That's because we are sometimes having too much of an optimistic occupancy assumptions. Sometimes we can have unrealistic ADR growth, right? Or we can underestimate the ramp-up period. So in Egypt, I would say one of the components that we always need to keep in mind is the failure to model currency risk. So if I would be running a feasibility analysis in Europe, I would be doing step 1 to 5. But if in the case of Egypt, you want to model what would happen if the overall currency appreciates or depreciates significantly, what would be the overall implication, and that needs to be priced in the overall evaluation. Again, from an investor perspective, what that means is it means because we're taking on more risk, more uncertainty, we will ask for a higher hurdle, right? So, but it's something that needs to be taken into account. So let's go a little bit deeper on the overall market analysis. So think about the main 3 pillars that you have for Egypt. If we're coming up with a new hotel or an evaluation, we need to think of the 3 distinct pillars. So first of all, we have leisure and resort. So we have the Red Sea and the Mediterranean coast. We have Hurghada, Sharm el-Sheikh, and now the North Coast where the Ras El Hekna is developing more. Right. We have the second category or the second pillar that's focusing more on corporate and MICE. So think about Cairo and the new admin capital, right? Business travel, is there any significant increases that we are expecting? How much demand is there going to arrive, right? And then finally, the cultural tourism, which is, again, as we are sitting in one of the 7 wonders of the world, that will always consistently generate a lot of cultural tourism. So depending on the feasibility analysis, each segment will have a specific risk-return profile, right? So leisure always has had proven demand, but faces a lot of new supply, right? So that means there's a lot of hotels that are coming. So what will be then the impact of these into a hotel valuation, right? And then in the corporate segment, you have a lot of high conviction, a lot of expectation, a lot of fresh demand, but we haven't had an opportunity to test it yet. So we need to see what the actual dynamic will be, right? And then when it comes to cultural tourism, that's the easiest to defend. Assets normally that are located closer to the heritage sites are usually unique, are irreplaceable, right? So that's quite a straightforward overall analysis. If you have any questions, you can also raise your hand now. By the way, personally, I don't mind. For me, I sometimes like to have a little bit more dynamic. So if you have something to add or a particular question, please go ahead. So you cannot perform a feasibility analysis without understanding the P&L of a hotel, right? So it's always something that you need to train yourself perhaps a little bit further, right? But it's basically what is the anatomy of the hotel that we need to structure that will generate profit overall, right? So we usually follow a waterfall model. You always start with revenue, you deduct your operational expenses, then you have your departmental profits by department. So think about F&B, rooms, other minor operated departments, right? Then we subtract all our admin, marketing, maintenance costs, and that will lead us to our GOP, which is usually the benchmark of the operator. That's the target that we will set for our operators. We will normally also have a target for them on revenue, right? When we enter a management contract, we'll set a base fee on revenue, but also an incentive fee on a GOP benchmark, right? So that that we need to keep in mind. So these are all performance metrics that I'm sure you've come across, but that I'm sure too that you always remember. As an owner, we don't care so much of the GOP. As an operator, that's what we care, because you are evaluated on that performance, right? But if I am performing an evaluation of a hotel, as in how much I would be willing to pay for this hotel, obviously it's an important component, but I want to know how much there's left after I remove all the reserves for renovation, after I remove all the payments to the debt service for the bank. What is left for the owners, right? So that's what we need to always keep in mind. So now that we have understood how the overall feasibility work, how the P&L and the financial projections can have an implication, now we can go into more real estate investment appraisal techniques. Here I will be discussing three simple overall analysis from an investment perspective. We have the payback period, the net present value analysis, so these are financial terminology, and the internal rate of return calculation. Out of these three, obviously the net present value, that would be the most important one, the most meaningful one to understand. So all of these questions will normally answer the question, so all of these methods will answer the question, does the return from these projections justify the risk that we're taking of locking a lot of capital on a particular destination, right? And we will see how they overall work. And then based on our overall decisions from the investment appraisal, we need to decide, is it a go or is it a no-go? How are we going to finance this overall operation? How do we select our operator? And then moving on to the next steps. So why is it important to apply these investment appraisal techniques? Well, that's because, first of all, that is a requirement by the bank, right? If you need to raise capital, you will need to document that your overall idea or your investment is actually feasible, right? So that's an important element. But essentially, we use that to project our future cash flows. That means, what will the investment generate over the next 10 years? I need to invest based on my cost estimation, $100 million US. What does that mean in terms of future projections? If we are running the hotel, we expect to run the hotel forever. However, we need to stop us at a certain point, right? Because that means that after 10 years, I'm not able to forecast with certainty anymore. So that's why we usually stop at a particular destination, the particular moment in time. But you could also forecast for 15 years. You could also forecast for 20 years, right? At a certain point, the numbers are not reliable. So we also use investment appraisal to quantify risk, to quantify uncertainty, using our cost of capital as a discount rate, right? And we also use it to look whether a particular investment is actually viable. We don't only use these techniques only for hotel evaluation, but we also use them. Shall we refurbish our rooms right now, or shall we do it next year? Shall we invest into some particular sustainability certifications, right? Shall we renovate a particular area of the property, or shall we lease it out, or shall we transform it into something else? So all of the financial decisions that you need to take, they need to be based on an investment appraisal. So these are the three core methods that I mentioned before. The payback period, I'm just going to briefly mention that, is normally easy and has a lot of flaws, right? Normally it means, if I'm making an investment of $1 million and it's generating $200,000 per year, that means that it will take me 5 years to recover my initial investment. So a lot of investors, they want to know, if I'm making a certain investment, how long will it take me to recoup or recover my initial investment? Yes. However, it's incomplete because it doesn't take into account risk. It doesn't take into account what we call time value of money, right? And then what happens after 5 years? What if after 5 years there is some elements where I need to, I don't know, pay certain fees, pay certain fines, pay certain renovations that will cost more and more money in the future. So this is a simple idea, but it doesn't work. That is why we apply the net present value of what we call the golden rule. There is a lot of names for it, so don't only just remember one name. We call it net present value. We call it the income capitalization approach. We call it the discounted cash flow approach. So all of the different names. But essentially means we are projecting the next 10 years of cash flow. We need to determine a minimum discount rate, meaning a minimum required rate of capital. I think someone...
Here, can you please find the person?
Can you please mute Asaf Hamdi? Asaf Hamdi, can you please mute your...
I muted him. It's okay.
All right, good.
So the weighted average cost of capital will determine the minimum required return that we want from an investment. In that, we need to also take into account any additional premium for the location, any additional premium for the risk that we're taking, right, for the currency. All of that will be reflected on the required rate of return. In Egypt, I would expect an expected return, a required return anywhere from 18 to 20%, which sits onto a higher overall expectation compared to more mature markets, particularly in Europe. You're looking anywhere from 7 to 15, right? But again, as I mentioned, there is the currency risk, and obviously the geopolitical situation sometimes can have that overall impact as well. But location, the brand that you're bringing, the operator, the market maturity, all of these will have to be factored on the required rate of return. That's where all the risk is captured. Some of that risk is also captured on the cash flow, but that will simply mean a more pessimistic expectation or a more optimistic expectation, right? Here we are using certain percentages that we want in return. Yeah. If the present value of all the future cash flows that we expect is higher than the initial capital, so if the net present value is above 0, that means that the project is actually creating value, and we will recommend that project to make the overall investment. Okay, so that's it's a very important component. Okay, and then finally the internal rate of return. This is quite similar to the NPV. However, the internal rate of return is the rate of return that gives you an NPV of 0. We also call this as the true rate of return. If a project has an internal rate of return of 20%, it means the actual return of this project is 20%. If it's 14, it's 14%. We compare the internal rate of return with the cost of capital, or with the, as I mentioned before, with the WACC. In other words, we say this project is giving a return of 14, and how much do the owners want in return? If the owners want 12%, then we say, well, project is giving 14, the owners want 12, we are creating 2% of additional value. So we will pursue the project. It's an easy one. However, the net present value gives you a dollar measure of how much value is created. So that's why we use more the net present value. Okay. Any questions so far? When it comes to the cash flow estimation, what we need to keep in mind is the initial capital outlay. So how much will it cost the construction? How much will cost the equipment, the licenses? This is used to determine the overall development cost of the hotel, and the last three components that will determine the value or the future value they will create. So we need to then benchmark these two together, right? Some common mistake that a lot of investors normally do is sometimes we underestimate operating costs, and that creates too much of an optimistic overall expectation. That's why we need to do some feasibility and some scenario analysis. Sometimes we overestimate the revenue impact, particularly for F&B departments, where obviously it's an important component of the hotel, right? But in many cases, it does not generate a lot of return. So we always want the F&B department, in terms of departmental expenses, to at least contribute about 15% to the overall P&L, so that it can absorb the shared costs between the different departments, right? Ignoring working capital needs, that could lead to short-term operational challenges if you don't have resources to manage your day-to-day. And then currency risk, I've mentioned that, particularly important for markets like Egypt. All of these projections, we need to keep in mind the time value of money. The projections happening in 10 years, they're not, so $1 today is not worth the same as $1 tomorrow, right? The money today is worth more than money in the future. That's part of the overall opportunity cost of our investment. We're expecting, as I said, 12 to 18. In my view, that's a little bit low at this stage. I would expect any towards the high double digits, so 18 to 20. And then Europe would be generally around 6 to 8%. I think we already spoke about that. Once we have our overall capital appraisal model, we need to think about risk and sensitivity, because everything we're doing is on paper. There's a lot of assumptions that we're making, right? And we need to know how sensitive our profit will be to overall these assumptions. So try to have some sensitivity or scenario analysis on market risk. What happens if we are assuming 60% occupancy instead of 80%? What would that mean for the overall profitability? If our staffing costs are going higher, what will that mean to the overall value of the hotel? If the financial risk continues to worsen, what will be the overall implication to the value, and any geopolitical risk, right? So all of these contingency, all of these risks, they need to be priced, okay? Obviously, sometimes they're not fully financial. Sometimes it's not always easy to capture these financial components, but again, they have implications and they need to be addressed. We also perform scenario planning, a best case scenario versus worst case scenario. What is the value depreciation? Okay, so what's the value, kind of line between one best case scenario versus a worst case scenario. We can usually perform risk mitigation strategies to control or to lower the overall expectations of these overall risks. For example, we can diversify in operating in different regions. So if one goes not so good, then we can adjust that with other investments. We can negotiate more flexible contracts. Sometimes, particularly in markets when there's a lot of currency risks, we want to hedge. We want to hedge energy prices. We want to hedge currency risks in order to have some level of certainty, right? And sometimes we make investments in phases so that we don't deploy the overall capital all at once. Financial appraisal is one thing, but it's not the only thing, right? We always have to keep in mind, how does the overall investment affect the guest experience, right? That is normally not measured during in capital or currency values. ESG, is the hotel going to enter into ESG investment? Are they going to get the sustainability? The main reason why this is relevant, number one, is it can influence guests that are more sensitive to sustainable undertakings, right? However, from a financial perspective, it also signals how much capital access you can get. If you have a certain sustainability certification, that means you can attract investment from pension funds, you can attract investment from investment funds that are usually delegated to invest in sustainable types of investment. What's the cultural, what's the social impact? Again, you're operating in a country that has a huge amount of local regulations, heritage preservations that you need to comply with, right? And obviously you want to make sure that it has an impact also to the overall community, so it affects the overall brand value, right? And then obviously the last question on how a specific investment fits with the overall long-term vision of the portfolio. So last slide to conclude everything together. We are usually using the payback model for screening investment opportunities. Then we apply the net present value as the final metric of whether we should make an investment or not. We use certain assumptions when it comes to getting our cash flow right. We are trying not to be very pessimistic on our approach, but also not too optimistic at different times. That's why we perform sensitivity analysis. That's why we perform scenario analysis and find out some contingency plan. And we also need to consider our non-financial components such as guest experience, sustainability, and an overall strategic fit.